what your routine is. So if you send that in a tweet reply to this, try to be brief or whatever. It'd be cool for the community, and plus, I'm being inquisitive about it as well. But when I wake up, if I'm napping in the afternoon, because I do generally try to take a nap in the afternoon before the PM session in S&P, I will again hydrate. But if I'm waking up for the morning session, the first thing I do is hydrate. I drink 20 ounces of spring water. And then that's important because you have to have, number one, you have to have liquid. You have to have it. Your brain will function better. Your muscles will be hydrated. You'll get less muscle cramps. And generally, I have a half a banana, and that'll give me potassium, because standing in one spot, and or if you sit, I don't like to sit because my back won't let me do it. But if you do that for a long period of time, you'll get crampy. And I'm not sure if you ever stood or sat in front of charts for a long period of time and you start getting that crampiness in your lower back or somewhere in your body, or you get a muscle cramp somewhere, you can't focus on the chart. You're worried about that damn cramp that's going off. So one of the best things you can do is start your day with hydration. And then I stretch. I go through a routine of stretching. And that's about all I'm going to do for this discussion here, because everything else is obviously shown in that tweet months ago. But what I do is I refer to the economic calendar again, because when you wake up from a nap, or if you slept overnight and you're getting ready to do your morning session in trading, it's very easy to lose your bearings. You ever wake up, and I'm 50 years old, and I've had episodes in the last 30 years where I woke up and literally felt like I was late for school. I haven't been in school for a long, long time, but it's just weird how our minds are so powerful when we're sleeping. And when you wake up, you are in a altered state. Like, you're not really awake yet. Your eyes might be open. Someone may be talking to you and you're looking in the direction that they're talking, but you're not really there. So you have to obviously refer back to what it is that you're going to be doing, because you could remember something about an economic calendar event. And I've done this. Okay. So I thought that there was going to be a report due, and it wasn't due. And I'm expecting something in the marketplace, and then realize, oh, what am I doing? I'm in the marketplace trying to do something, and that's not even due out today. Or if I'm waiting for an 8:30 morning news embargo to lift and there's no news coming out. So I have to make the decision. Do I hold on to this trade idea if it's in drawdown and try to get out with close to even, or if I can squeak out a win from it? Or do I just cut bait and just take the small loss because I did something incorrect? These are all things I have done coming up. Okay. So if you've ever had that happen, just know that you're in good company, because I'm not ashamed to say that I did those things too coming up. So you have to definitely review the economic calendar. Now, what economic calendar do I use? Well, I used to use Econo Day, and I mentioned that when I was on Baby Pips. And when I went to teaching predominantly Forex, I grew to appreciate and like forexfactory.com's calendar. I think it's easy. It's easy to manage and filter. I don't like looking at the yellow low impact events. I only looked at the pairs that were of interest to me, but always the dollar. And when I was trading Forex, it would be the euro dollar, the pound dollar, and the US dollar, and only medium impact and high impact news drivers. And I would toggle the little gray box because it would tell you bank holidays and things like that. But other than that, that's pretty much what I would use for an economic calendar. The review of what I thought would come the previous day. So in other words, whatever I thought my analysis would see in price delivery, for instance, what did I think was going to happen in euro dollar? Okay. Or what did I expect to see in E-mini S&P before I laid down? Okay. I have to revisit that, because while I was sleeping, bombs could be dropping somewhere, a new virus gets released, some kind of boogeyman, narrative gets put in motion, or just simply, a collapse of some kind, or something that I didn't expect and I was wrong in my analysis. The market has done something that I didn't expect and I was wrong. So I have to recalibrate myself and say, okay, what did I expect before I took the nap or before I went to bed? And then when I go into the economic calendar, I have that reminded because if I expect something to come into the marketplace in terms of volatility, that's what the high impact and medium impact news drivers are for. We want to know when it's likely to increase in volatility. Okay, it's one thing to be like in an earnings season. Like in earnings season, futures, they get wild many times after the close. Okay, and we also know that in Forex, we don't really have earnings season, but we do have economic drivers that come out and they're set to a specific day and time, much like a TV guide. Okay, I'm a child of the 70s. I was born in 1972. And when we grew up, all you young guys and gals out there are used to having the TV guide or the guide on your remote. You push your button and it tells you what's on TV right now and what channel. And you can scroll ahead in time and see what's on. We only had that luxury with a little magazine, and it was a TV guide and it was published every week. Well, these events or not topics, but these events and or opportunities in trading are basically scheduled like TV programs. Okay, your high impact and medium impact news drivers are scheduled well in advance. Like you can see 2-3 weeks from now when these things are coming. So you're not surprised by it, or you shouldn't be. Okay. So by having that understood and what days of the week are likely to create these increases in volatility, so you know what that volatility is going to bring with it, the strong likelihood of manipulation. And that's one of the key factors or ingredients to what we're looking for smart money. We want to see some type of manipulation. And I'll get to what that manipulation should look like in a moment. But I'm referring to the economic calendar, making sure rather that I'm in front of the charts for the right reasons and I'm following the right market. So if you're a Forex trader, you want to be looking for your pairs that have the currency news driver that has a high or medium impact news driver coming out around it. It'll tell you the time. And most of the time it's 8:30 in the morning, or if it's US based, it may be something like 9:30 or 10 or 10:30, like for crude oil inventories. And you can trade Canadian dollar, just on that report alone. But referring to your previous session or before you went to sleep's analysis, is that still hold true? Or does it hold true? Or has something changed while you were away from the charts? If it hasn't changed, then you go through the process of trusting it. And what type of analysis would that be? Well, number one, I start everything on Saturday. And I look at what I think that weekly chart's trying to go to. Is it going higher or is it going lower? I'm not trying to predict Friday's closing price. I don't teach my students to try to predict the Friday closing price. Okay. So many folks have listened to me, taken things out of context, and spread so much misinformation about what it is I do as a trader, how I teach as a mentor, and what my students are focusing on or should be focusing on. They have made so much more confusion. And this is why another reason why I hate when people try to teach my stuff, because you don't know what you're doing. Watching a video, listening to a video series, you don't know. And just repeating what I'm saying, you don't know how to answer a question when someone gives it to you. How do I know? Because those same people that are running mentorships are asking me the questions in my forum so they can answer their customers. Yeah, I know. So if we know that the weekly chart is likely to go higher. Now, when I say if we know, how do we know? Well, we don't know with 100% surety that it's going to go up or down. Our analysis is never guaranteed. That's why we have to have stop loss. But I want you to think about how when you watch me trade these intraday movements, and I'm on a 1 minute candle. Okay, number one, I'm canceling out all the arguments from the Goldman Sachs boys that say it's just noise and there's no pattern. Okay, there's no consistency or continuity found in lower time frames. These are people that don't know what they're talking about. And you've seen now students and me do this consistently with precision. But what I'm showing you is where I think the market's going to go to, the draw. Okay, that's the first question you need to address on Saturday, or if you do your analysis on Sunday. Some of you are probably listening to this after church. That's fine. But whatever that day is on the weekend, Saturday or Sunday, that is the day you're focusing on. Where do you think that next candle, when we start trading on Sunday evening and the markets open up, is the market going to expand, not close high or low? Is it going to expand? Is the largest portion of expansion in that weekly candle? And what do I mean by that? If you were to measure the highest high and the lowest low after the week closes, okay, was there more expansion upward or downward? That's the question that I teach my students to aim for answering on the weekend. You're looking for that. Okay. That gives you the absolute strongest bias filter you'll ever fucking find. Okay. Because what you're doing is you're patterning it off of large institutional flows. Ooh, what does that mean? Well, large institutional flows are big funds, big hedge funds, big deep pocket entities. Okay. And they are not trading on 1 minute charts. Okay. They can't put their size into the marketplace on a 1 minute candle. So they require weekly and daily levels. And that order flow that comes through that time frame, that's the elephant. That's the trail of elephant footprints that we're looking for. And smart money is a big elephant. It's lumbering. Okay. It has to take a long time to work in its orders to get into a position. Not the start of a position. Obviously, any position entry that constitutes their participation, obviously, right? But they can't put all of the size that they want on just in one trade. Like you go in and put in your 10 lots or your 5 lots or whatever, and it's done in one clip. Boom, it's done. They don't even break the order up. But large entities and large hedge funds, they have to break their orders up and they scale them in. So they're requiring a longer term price swing. And we derive that from the weekly chart. So the weekly chart, the only thing we're trying to do is capitalize on focusing on the next expansion on that weekly candle, removing the importance of knowing how it's going to close. We don't care. We just know that if that 1 minute candle, I show you example after example after example of how the market moves from a order block or runs out liquidity and runs for buy side liquidity, whether it be a single high or a relative equal high, that draw on liquidity is the focus of where I think price is going to go. I'm holding that trade until I'm stopped out or it reaches that target, the draw on liquidity. So for the sake of argument and understanding, let's just say that we believe that that 1 minute candle that we are trading in is bullish and there's buy side liquidity above relative equal highs. When a trade is entered, or for instance, when I have entered a trade and you watch these videos pan out where the market just keeps going up and up and up, and it might have small little retracements, but it ends up going to where I'm aiming for and my limit order gets hit. Every individual 1 minute candle, think about that same 1 minute candle as a weekly candle and apply the same logic that I outline in my 1 minute setups. Apply that to that weekly chart. It just takes a whole lot more time to submit to it. So when we're looking at a weekly chart, we're not just trying to guess on the next candle without any kind of logic or rationale behind why it should go up or down. We're looking at where has it been? Did it just take sell side? Has it taken sell side and has yet to trade up into a sell side imbalance, buy side inefficiency? Or has it taken a level of buy side on the weekly chart yet? If it hasn't, guess what? It's likely to continue going up. So that's how easy it is for me to say, I expect this week to have a expansion on the upside on the weekly chart. So if that's the case, that makes me trust initially going in, I want to be in a buy model. So my weekly analysis is framed on, I predominantly want to put my larger positions if I'm going to be trading intraday. I want to be focusing on being a buyer, and I'll do full maximum leverage if the trade is viable. That doesn't mean I won't sell short. It just means that if I do sell short, I have to do half or less than what my full position would be on if I was doing a long in a buy model. I'm going to say that again because you probably just didn't even listen to it. And it doesn't mean anything to you because you want to hear something else. But what I just gave you was gold. If my bias for the week is bullish, my largest leverage, pyramiding, building up, using the largest positions I can put on initially and keep adding as equity allows me to do so, I will do that in long positions. If I'm going to go short anytime during that week, I must be at 50% or less of the largest leverage I would use as a trade that week. Because I'm going against what? I'm going against the order flow on the weekly chart. So I'm already building in and tamping down the likelihood of a big drawdown because I'm not opening myself up to potential losing trades with maximum leverage. Just because I'm good and nimble intraday, I'm cognizant that I can be wrong. So I build in these safeguards as best as I can and still be able to engage a short position if I'm in a buy model. But I'm not going to hold on to those shorts very long. I'm going to pick the easiest short direct run to a target and be done with it. And it might go many times farther than where I get out at. And I don't care because I'm going to go right back into looking for the next run on a buy side. You see what I'm saying? I'm filtering out the best of the best. But if I want to participate in a bullish market but sell short, I'm building in all of these ideas that would limit my exposure but still allow me participation. But also reminding myself I'm selling short in a market that I know is more likely to go higher. So I don't want to overstay my welcome. And what does that mean? Holding on to a trade too long or turning it into a swing trade. Or, oh, I was wrong about my weekly analysis. So now I'm going to hold on to this longer and look for even bigger objectives and move my limit orders down farther. And then have it turn against me and stop me out. Even if I've taken partials, I don't like that feeling. I like being out when I want to get out, and I don't mind leaving some meat on the plate. Everybody's got to eat, right? So you're referring to that weekly chart and defining whether or not you're going to be in a buy model or a sell model. And that, again, is defined by, do you believe the largest expansion from the open is going to be up or down? You're not trying to predict that weekly close. That's very liberating. When you come to terms with that, it's not complicated. All you're doing is you're subscribing to the same things that we look for in these intraday charts when the market's still drawing towards a old high or relative equal high, or if you're bearish, let's just say the weekly candle, you're expecting it to go down, the larger expansion going down, because it has recently, in recent weeks or in months, it has taken buy side and it's been dropping. And you can see clearly it's reaching for an old low, or it's about to reach into an imbalance, a buy side imbalance, sell side inefficiency. If it hasn't reached into it yet, then that means what? I'm going to side with the likelihood of the next weekly candle or the one that's about to open up tonight. And I'm not saying this is the case for this particular week. I'm just giving you the routine as what this topic is. Then in those instances, I would be in a sell model. That means I would be doing the largest position in leverage on my shorts. If I'm selling short, I'm going to be willing to use the largest leverage that's available to me. But if I go long anytime during that week, I have to be at 50% or less, whatever my largest maximum leverage would be if I was going short in a bearish week. Okay, very, very important. Very, very important. Those things helped me a lot in my 6th and 7th year. Once I figured out what I was trying to do, that kind of kept me from wrecking myself, because it would be harmful for me to just, I guess not, no, to eliminate the idea of getting drunk with the volatility of buying and selling, because I can do both just about any market condition, unless it's a one-way straight, rip rate from like a CPI type event. you're not doing both directions in that. With those instances put aside, I can buy and sell in a market condition pretty much intraday. I can do both sides. But just because I can, does it mean that I should just do it because I can? No, I want to maximize when it's on the right side, when it's in line with that weekly expansion, because I'm in line with the large flow, large institutional order flow on the weekly chart. If it's bullish, or if I'm anticipating it to be bullish, I want all of my emphasis on being long and the leverage behind those trades to be at the maximum there. I don't want to be maximizing my risk and use the largest leverage in a time when I know in my analysis that it's likely to go higher based on the weekly analysis. I don't want to be going short with the largest leverage, because what I'm doing is I'm inviting the market to whip my ass and to do it the best way it can with the maximum effect. So I want maximum effort on my side. I don't want maximum effort on the risk side where it could punish me, much more than I would want to suffer. So that's the reason why I do that. But when I go through the economic calendar and I remind myself of what I'm looking for and when the volatility should come into the marketplace, when does those high impact or medium impact news drivers come in? And then I'm waiting for that to occur. If my weekly analysis is aiming for or indicates to me through my own interpretation that it's bullish and I'm in a buy model, I prefer to see some kind of bearish drop at that medium or high impact news driver, preferably into some kind of buy side imbalance, sell side inefficiency, or below relative equal lows, or a single 15-minute candle low. Now, 15-minute is my bellwether. Like, I could trade everything in every model that I know. I can use just a 15-minute candlestick chart and do everything I can do. Period. I don't need to drop lower and I don't need to go any higher. I could just simply trade off that. That is not an invitation for you to say, okay, ICT said that, so now that's what I'm going to do. Your bellwether might be an hourly chart. It might be a 5-minute chart. It might be the daily chart. It might be a 4-hour chart. Don't let me, as your mentor, influence you and you copycat every single thing I say I do. That's the worst thing you can do as a mentee with anyone. You have to bring your own personality, your own influence, the things that are meaningful to you, your signature, your fingerprints. They have to be all over this. You can't just say, I took ICT's 100%, everything he said verbatim, and now it's mine. It might be for some of you, but I don't want that. I'm not trying to create copycats of me. I'm interested, very, very interested to see how all of you adopt this idea and formulate your own approach using the tools and concepts, because it's all going to be slightly different and you're all going to get a unique result, and you can all be positive. You can all be making money on the same day doing different things. That's the beauty of this. It sounds like it can't possibly be like that, but it's exactly how it works. And vice versa. Sometimes you'll have winning trades and other students that'll be doing this the very same thing you're trying to do. They'll have the opposite result because they're bringing in their problems, like I mentioned yesterday. So